Welcome to TalkTickers, your deep dive into the latest earnings calls. Today we're digging into the Q2 2025 earnings call from BLNK Charging Co. That's ticker BLNK. They're a pretty key player in this whole EV charging sector. And this call, well, people were definitely waiting for it, especially after kind of a tough start to the year for their product sales. We're basically here to pull out the important bits from their report, help you understand what really went down.
Yeah, absolutely. And, it's interesting how the market reacts right away. Sometimes that tells you a lot before you even crunch the numbers. On paper, BLNK had, well, let's say a bit of a mixed bag, but the strategic stuff they talked about, their outlook, that clearly hit the right notes with investors. It's definitely complex, but it looks like a real signal of change, maybe even, an inflection point for them.
Right. The market reaction was quite positive then. So let's unpack the main numbers first. What were the sort of headline financials for Q2 and how did they stack up against what analysts were forecasting?
Okay, so the top line, the revenue, that was pretty solid. BLNK reported $28.7 million in total revenue for Q2, and that did beat the consensus estimates. What really stood out, though, was the growth from Q1. 38% jump sequentially. Pretty significant.
38%, wow.
Okay.
But what about the bottom line? The earnings per share.
Right. Well, that's where it gets mixed. They're non-GAAP EPS, that's earnings per share, but adjusted, to take out certain one-off things for a clear picture of core operations. That came in as a loss of $0.26 per share. And that loss was actually wider than the analyst consensus.
Okay, so revenue beat, but a wider than expected loss.
So why do you think the market reacted so positively then? That EPS miss seems like it would be, concern. It's a good question. I think it really comes down to the strong sequential revenue growth, that momentum they showed. That plus all the strategic updates they laid out just seemed to outweigh the EPS miss for investors. I mean, the stock price jumped quite a bit in after-hours trading. It suggests the market's looking past the immediate loss per share and focusing more on the strategic direction, the execution, the bigger picture shifts. It shows that even when things are tough, seeing growth where it counts can really boost confidence.
Yeah, that makes sense. Investors looking forward, not just back. So beyond those top line numbers, the operational details are usually where the real story is with BLNK. Where did they see the biggest momentum in revenue? What does that tell us?
Right. This is where it gets interesting operationally. Product revenues shot up 73% sequentially compared to Q1. This was driven by really strong demand for their DC fast chargers and also the Level 2 series units. And it wasn't just a blip. They saw that momentum build right across the quarter, April, May, June. It shows a clear trend.
73% sequential growth in products. That's huge. And it wasn't only products, right? Service revenues look strong too.
Absolutely. Service revenues grew really robustly, up 46% compared to last year and 11% just from Q1, hit $11.8 million. And this is so important because it means more people are actually using their chargers, right? Increased utilization. Plus, it shows growth in the chargers BLNK actually owns and operates. Get this. Revenue from their BLNK-owned DC chargers, they've got about 150 in the U.S. That revenue jumped over 300% year over year.
300%. Okay, so owning and operating is paying off.
Seems like it. And they reported record energy distributed 49 gigawatt hours. That's up 66% year over year. Again, points to more usage. Oh, and their other revenues were up too, 47% year over year, mostly from warranty stuff.
So strong demand, strong utilization. It paints a pretty positive picture on the growth side. Now, how does this connect with profitability? Let's talk about that BLNK forward plan and costs.
Yeah, it's fascinating because alongside that growth, they're really pushing hard on costs and profitability with this BLNK forward thing. So the reported gross profit was $2.1 million. That's a 7.3% margin. But, and this is key, if you exclude some non-cash items like $4.7 million in inventory adjustments and a $1.7 million write-down of capitalized costs, basically stuff they'd put on the books as assets that are now worth less. Their adjusting gross profit looks way better, $8.5 million. That's a 29.7% margin.
Okay, wait, so 7.3% reported margin, but almost 30% adjusted? That's a massive difference.
It is, and it shows that while they had some necessary cleanup costs, maybe related to past inventory or assets, the underlying operational gross margin, the core business, is actually quite strong.
Yeah, that adjusted number definitely tells a different story. What does that kind of gap usually signal? And how much impact are these BLNK forward cost cuts really having?
Well, the gap highlights something crucial for companies like BLNK in these competitive growing markets. You've got to separate the sort of historical cleanup from the actual forward-looking efficiency, These adjustments show they're tackling those past issues head on, and BLNK forward seems to be working. They cut compensation expenses by 22% just in Q2. Plus, Management said they expect to cut another $8 million in annualized non-recurring costs, things like workforce reductions, less spending on consultants going forward.
So real savings starting to show up. What about overall operating expenses?
Right. GAAP operating expenses were $34.3 million. But again, if you adjust taking out $10.1 million in non-cash charges and $5 million in one-time comp and professional service fees, the adjusted operating expenses would actually show a 23% improvement year over year. So costs coming down significantly on an underlying basis.
23% improvement, adjusted. Okay, so it's not just talk, they're actually trimming down. Makes you wonder, though, how much leaner can they get while still trying to grow so fast? Is there a limit to these cuts?
That's always the balancing act, isn't it? Management did hint there were still more cost-cutting opportunities. I think the goal isn't just lean for lean's sake, but efficient and strategic. Getting that efficiency right is absolutely critical long-term, especially with the margin pressure everyone's seeing in this industry.
Efficiency is key, especially when you look at their cash. They ended Q2 with $25.3 million in cash, down from $55 million at the end of last year. They burned through about $16.7 million in Q2 alone. That sounds like a lot. But you mentioned something important earlier. They have no cash debt. That's a big deal, right?
Exactly. It's a really critical point for a growth company burning cash. Having no actual cash debt gives them a ton of financial flexibility. It means less risk, less pressure. They can focus their money on operations and strategic moves, not just paying interest. And that brings us right to those strategic initiatives, which, like I said, seem to be a big reason the market reacted so well.
Yeah, let's get into those. First up, that Zometric acquisition back in July. Why did they do that?
Right, Zometric. That move basically filled a big hole in Blink's product lineup. They needed something good for the more price-sensitive markets, like fleets or apartment buildings. Zometric brought these smart, interoperable AC Level 2 chargers, and crucially, AI software for fleet management. It looks like a classic consolidation play: plug a gap, get tech, get talent, fast. And they did it mostly with stock and earnouts. Very little cash was the phrase used, which is smart given their cash burn.
Stock and earnouts. Saves cash now, but potentially dilutes later, or depends on hitting targets.
True. There are always trade-offs with those structures.
Yeah.
But it gets them the tech and talent now. Speaking of talent, they got Zometric's founder, Harit Singh, as their new CTO, plus Bonnie Data and Kapil Singhi, key people. And Zometric's Shasta line of chargers. Already in UL testing, they're aiming for volume production in October. That's quick integration.
Okay, so fast integration on the product side. What else happened strategically in July? Something about Envoy.
Yes, the Envoy liability resolution. This was another big one. Blink basically settled with former Envoy shareholders. They got released from a potential $23.5 million liability. It was a contingent liability, meaning it might or might not have become due. They settled it for $10 million in Blink stock and $11 million in performance-based warrants.
Performance-based warrants, what does that mean?
It means those warrants only become actual shares if Blink's stock price hits certain levels, $1.70, $2.10, and $4.85 specifically. So it cleans up a major potential financial headache from their balance sheet, reinforces that debt-free status, and gives former Envoy holders upside only if Blink performs well. It provides clarity.
Got it. So removing uncertainty, that makes sense. And wasn't there something happening in the UK too?
There was. Mid-July, they signed a non-binding term sheet with a UK private equity firm, Axel Trova. It's for a $100 million special purpose vehicle, an SPV. Basically, it's a separate company set up just to fund and accelerate EV charging projects in the UK under the government's LEVI program. The really interesting part is how they're funding it. Non-dilutive off-balance sheet capital.
Non-dilutive off-balance sheet. Okay, break that down.
It means they're finding money for major expansion without issuing more stock, which would dilute current shareholders, and without taking on traditional debt that sits directly on their own books. It's a clever way to fund growth in a capital-heavy business like charging infrastructure. Very innovative.
Wow, okay. Zometric acquisition, Envoy liability gone, UK funding vehicle. That's a lot of big moves quickly. And they brought in some new leaders to help manage all this, right?
They did. Chris Carr joined as SVP of sales back in February, and apparently his team's already making progress, which fits with the revenue growth we saw. Then Michael Bercovich came in as the new CFO just in late June. His focus is on efficiency, long-term growth, profitability, right in line with Blink Forward. And Alex Kellman got promoted to lead their European operations. So yeah, definitely shoring up the leadership team for this next phase.
Makes sense. If we zoom out a bit, how does management see the whole EV charging industry right now? And how do Blink's moves fit into that?
Well, management described the sector as basically going through consolidation and facing margin pressure. That's pretty typical as a high-growth market starts to mature. And Blink's pivot, focusing more on services, differentiating with tech like Zometric's AI, using these clever funding structures like the SPV, it seems really well timed for those trends. They seem to be positioning themselves not just for today, but for what the industry will look like tomorrow. It's about adapting to compete effectively as things shake out.
Adapting to survive and thrive. Got it. So looking forward, what do they actually guide for the rest of 2025?
They expect that sequential revenue growth to continue in the second half, across products, services, everything. They also expect cash burn to decrease. Why? Well, because of that revenue growth, the lower operating costs from Blink Forward and getting better at managing working capital, like collecting payments faster. They didn't give specific dollar figures, no quantitative guidance, but they definitely laid out a path towards, better financial health and efficiency, a clearer narrative.
Okay, a clearer path forward. So for you listening, what are the key things to watch? What are the potential catalysts for Blink?
Good question. Internally, the big ones are, can they keep that sequential revenue growth going? That's number one. Number two, successfully rolling out that new Shasta charger line from Zometric. That needs to hit the market well. Three, seeing the real benefits of integrating Zometric, the tech, the talent, does it all mesh? And four, continued cost cuts from Blink Forward. Keep improving that bottom line. Externally, things like faster EV adoption, more government money for charging, or even more industry consolidation could all help them.
Lots of ifs, but a clear set of goals.
Exactly. And look, the stocks had a rough ride, down over 50% in the past year, down about 27.5% year-to-date before this call. But this Q2 call with all these moves, it really could be an inflection point, a shift towards being leaner, more tech-focused, more service-oriented. It's definitely a story to watch. Those historical stock numbers might not tell the whole future story if they execute this pivot.
All right, we've broken down the call. Now let's shift gears slightly. This is our not financial advice segment. We explore an outrageous but plausible trade idea based on what we've just discussed. Seriously though, this is just for fun, for educational chat. Don't take this as advice. Always do your own homework, especially in EV land. Things can be, volatile.
Extremely volatile. Okay, so my outrageous but plausible idea for BLNK. It involves going long the stock combined with a laddered call option strategy, given the stock price was around $1 or $3 after the call reaction, and given the strategic clarity we just talked about, there's a pretty clear, tangible link to those Envoy warrant vesting prices we mentioned earlier.
The $1.70, $2.10, $4.85 warrants. Okay, so how would this trade work, theoretically?
Okay, the basic idea. Maybe buy some BLNK shares directly. That's your foundation, your direct bet on the company executing its turnaround. You're hoping for a decent return as they clean things up. But then here's the outrageous part. At the same time, you could buy some relatively cheap, out-of-the-money call options. Specifically, pick strike prices that line up with those warrant vesting levels, $1.70, $2.10, and maybe especially that $4.85, and maybe especially that $4.85 when those warrants have, I think, a 20-month expiry, so you've got some time.
Okay, so buy the stock and buy calls at those specific warrant prices.
Yeah.
What makes it plausible, though, not just a lottery ticket?
Because it's not just a random guess. It's a bet tied directly to the execution of specific things management just announced, things the market already reacted well to. If Blink actually delivers on this sustained revenue growth, gets the Shasta chargers out, integrates Zometric well, cuts costs, then hitting those stock prices, which are still pretty low historically, becomes much more likely. And the leverage from those call options means even a small amount invested could potentially give a really outsized return if the turnaround works and the stock gets re-rated. It's basically a leveraged way to bet on them successfully shifting from, let's call it survival mode, towards actual profitable growth.
That's definitely an interesting angle, tying the trade mechanics directly to those predefined milestones from the Envoy deal. Bold, but logical. Certainly food for thought, highlighting how operational execution can sometimes create very specific financial opportunities, or at least potential ones. Okay, so let's wrap up Blink's Q2 2025 call. The big picture. A quarter that really seemed to turn things around after a rocky start of the year. We saw strong sequential growth, really impressive in products, and a whole slate of decisive strategic moves, acquisitions, liability cleanup, new funding paths. It definitely feels like a clear shift towards becoming leaner, more focused on services, and using tech to stand out.
Absolutely. And maybe a final thought for you, the listener, as this EV charging space keeps consolidating, how might Blink's specific moves like buying Zometric for its tech and using things like that UK SPV for funding how might that uniquely position them, not just to, survive the shakeout, but maybe to actually thrive and change the game a bit in the next few years? Kind of feels like their story might just be getting started or at least entering a really interesting new chapter.
Thought to think about, definitely. Again, this has been our deep dive into Blink Charging's Q2 earnings. It is absolutely not financial advice. Please do your own research. Think for yourself. If you have feedback for us or ideas for other calls you'd like us to cover, let us know. Thanks for tuning in, and we'll catch you in the next deep dive.